And welcome back to another video, another live. Let me click all of my buttons as I come in here, guys. As you check in, let me know where you're coming from, what city, what state, what country, what continent, what region of the world are you in? Let me know, guys. GDP, GDP, GDP. So let's talk about GDP on this video. What is happening in our economy all around us and how it will affect and how it may affect us as consumers. So as you come in, guys, we want to have a conversation today that's going to kind of really catch us up to date on what's happening with the U.S. economy. We got some big news today that I want to share with you guys. And if you're watching me on any other platform, whether it's LinkedIn, Facebook, wherever you're at, feel free if you want to come on over to YouTube because I may be sharing my screen at some point. But we're going to be talking about what's going on. First off the bat, high interest rates are here to stay. Okay. And when I say stay, I mean they're going to stick around for a while, in my opinion. Okay. That's first and foremost. We must know this as investors. So, investors, beware. All right. Beware. I want to talk about what we should be doing as investors as well. Consumers, investors, what should we be doing? Right. That's what I want to spend some time talking about as well on this live. Please, as you come in, if you're over here on YouTube, smash the like button. And again, drop that city or place where you're at in the comments, guys, and give me a thumbs up if you can hear me okay. Let me know that you can hear me okay. Let's see. Hey, we got Joe Mitch, a new member. Good to have you in here. Somebody's joining from Tulsa, Oklahoma. Good to have you, Curtis. MJ is joining from Hattiesburg, Mississippi. Good to have you. Hey, Jason, good to have you. Good to see you again, Jason. Thanks for being here. I appreciate you. Let's see here. Tracy says Tracy's in New York City. Gave me a thumbs up. I guess Tracy can hear me. Fantastic. So great. It looks like some folks can hear me. Okay. Columbus, Ohio. The Art of War. Sun Tzu is checking in. Good to have you here as well from Columbus, Ohio. So just this is important because, guys, I like to have a informed audience or informed group of people who sort of, you know, and I think I do have a really, really solid, smart audience here on YouTube. Folks that sort of know what's going on in the world, savvy folks that think hard and long about their money. And okay, I think we're still good. Let me know, guys. Give me a thumbs up if you can hear me. By the way, on YouTube, give me a thumbs up. Let me know that you can hear me. Okay. Let's see. Boston, Massachusetts is here. Good. Joyce is here. And hopefully you guys can hear me. Let's see. Boom, boom. I think I'm good with that. And okay, Winnipeg, Canada's here too. So we got some folks in different countries, which is always great. Let's see here. I'm going to do this. Yeah, and if you're, like I said, if you're not on YouTube, guys, you may want to come on over to YouTube because on YouTube, I'm actually going to be sharing my screen a little bit just to go over some of the stuff that we like to talk about. So let's see here. All right, great. Also, don't forget to hit the like button today. Let me just get some housekeeping things out of the way. Fresno, California is in the house. Good to have you. Metropolitan Detroit, Michigan. Salute to you, Jay. Good to have you. Today's live, guys, and Jay just mentioned it. I always like to mention Mint Mobile. Mint Mobile is my company in terms of premium wireless. They use the world's fastest and largest 5G network to bring you premium wireless services. That's why I like to talk about them. I have them. They've worked out well for me, so I at least like to partner with them on a lot of my videos. So if you want to save some money on a wireless plan, feel free to hit up Mint Mobile. There's a link in the description box. If you want to save some money, because that's what this channel is all about, trying to save you some money, check out Mint Mobile in the description box below. You want to consider them. Now, the other thing is this. My friends at StreamYard. I'm streaming this on StreamYard. Partner with them as well. StreamYard is literally, I'm going to be honest with you, StreamYard is probably the easiest application that I've used out of the 10 or 20 or 30 different applications I've ever used. It's extremely easy. I mean, it's like a child can use StreamYard. That's why I like them so much. But if you're looking to stream some video over various platforms, check out StreamYard. There's a link for them in the description box below. This is just housekeeping. I want to get at some housekeeping things kind of out of the way before we jump deep in, do a deep dive here. Also in the description box, you'll see 24 Laws of Money, my free ebook. It's yours, my gift from me to you. Check that out as well. You click on that in the description box, you have your free ebook. If you have a question throughout this entire live, put a big old Q in the front of it. And as we have this conversation, I will be sure to circle around and try to get you your question. More than likely, I will be able to. But if you have a Q in front of it, it's going to help me out a lot better and help me quickly identify the questions to answer. So, what are we talking about today, guys? We had some ginormous news. I like to call it big news that came out just this morning, early this morning. Sort of not so great news in a lot of ways, right? From an overall economic standpoint, the news wasn't all that rosy, to be honest with you. We got our first quarter GDP first reading this morning. First quarter for this year reading this morning, right? It's what they call the advanced reading for GDP. It showed a 1.6% GDP growth, which is slower, worse than they had been anticipating, right? And I'm going to dig into this, what happened and what's going on. We're going to dig into it a little bit deeper, but it came out this morning at only 1.6% growth. Still growth, but not nearly the growth that was anticipated for the first quarter of this year. So, quick rundown on GDP. Look, for some of you in this chat, you're super duper smart, you're super duper savvy with all of this stuff, right? But there's some folks in here that aren't. So what I like to do on this channel is give you this information in sort of plain language that almost like a sixth grader, seventh grader, maybe a savvy fifth grader could understand this information and break it down. So I want to talk about GDP. I want to talk about the stock market. I want to talk about my Fed funds rate, and I want to talk about what we should be doing as investors, right? As conscious consumers. We don't want to just be the consumer that goes to Walmart, comes home, goes to Kohl's, come home, go to Target, come home, not even thinking about the big picture of what's happening around us. A lot of times with us guys in America, this is real talk. In America, we get really, really focused on what's in front of us, right around us, and we don't have no clue what's going on in the world. See, when you live in a country like Colombia, South America, or you live in a country like the UAE, Syria, Yemen, you name it, Qatar, you live in China, you live in parts of Japan, you live in the Philippines, you live in Indonesia, maybe some of the islands, you live in Australia. In most parts of the world, people have to keep up with what's going on around them because there's a low level of threat and danger around people in most countries of the world. But when you live in a country like America or you live in a country like Canada, we could go to work, come home, go to work, come home for 35 years. We don't have to worry about a war. We don't have to worry about, well, in some places in America, we have in the last couple of years, but for the most part, we don't have to worry about somebody attacking America on American soil. So we live in a pretty cushioned place here in America. Let's just be real with it. We live in a pretty cushiony time because we don't have to worry about what 90% of everybody else in the whole world has to worry about. If you're living in, Namibia, or you're living in Sudan, or you're living in, parts of Morocco, or you have to be thinking about, you have to be kind of on your P's and Q's. And a lot of those people in other countries, they know they're more political savvy. They're more economical savvy. And so in America, sometimes we get in a cocoon. But I need to get you out of that cocoon and say, listen, this is what's going on in America. Even though it feels like it doesn't affect you at all and has you're cushioned from it, right? So I want to talk about our job and our role as investors and consumers, but I want to get some of the basics out the way. We always hear that the economy is growing, right? or we hear the economy is slowing down, the American economy. Those are terms that we hear a lot. But the problem is that most of us have no real clue. What does that mean that the economy is growing or the economy is slowing down? Well, the sort of macroeconomics or look at the big picture leaves most Americans kind of clueless, to be honest with you. And so let's just be real. Because we're clueless, a lot of things go right over our head and happen right around us, and we have no idea that they're happening. Laws being passed, bills being put forth in Congress. This is happening. We don't really know a lot about the big picture of money. Specifically, politically, we see that stuff on TV, but money, right? Because all we see and care about is the price of rent, the mortgage, and my interest rate, the price of bread, my credit card, and gas at the local gas station, right? Because that's what happens in America, right? But these things on a macroeconomic level sort of matter. These trends that are happening matter. What's going on with the Fed funds rate matters because they're moving in the background, but they can impact the stock market. And that's where a lot of us are invested in the stock market, right? So the stock market kind of moves and shakes with some of these things that take place, not necessarily directly, but oftentimes indirectly, right? Appreciate you. Rochelle from South Carolina. Grayman checking in from Philly. Bubba. Hey, how you doing, Bubba? SLC Utah. Not sure what that means. SC checking in. South Carolina, I guess it is. Checked in from Chicago. Kenny, good to have you. So just to be clear, first and foremost, let's establish that we understand what GDP is. GDP stands for gross domestic product, right? It's the final value of the goods and services produced in a time frame, produced over the course of typically quarters. Hey, let me ask this question to you guys in the chat. Somebody tell me, what country has the biggest GDP, the largest gross domestic product? In other words, the largest value of final goods and services produced in the world. What's the number one country? Let me know in the chat if you know that. The number one country has the highest GDP, produces the most final goods and services in the world. What is that country? Anybody know? Let me know. Oh, SLC is Salt Lake City. Okay, got you, Bubba. I didn't know. Kendall said USA is the top producer. BW said China is the top producer. Jason said China. Michael said China. Country that produces the most amount of everything in the world. Final goods and services. Somebody said, let's see. Charlene said China. Jay said China. Nastov said China. Gloria said China. Grayman said China. Jeffrey is checking in from Funkley, Minnesota. Good to have you. Bubba said the USA. Kiki said China. Here's the answer. The country that has the highest GDP in the world, gross domestic product, value of final goods and services, is the USA. Has the largest GDP in the world. Number two is China. But guess what? I bet you won't guess number three. What do you think has the third? After USA is one, America, North America, or not North America, United States is one, largest GDP. China is two, largest GDP. Nobody's probably going to guess number three. All right. Largest GDP, gross domestic product, the total amount of the final goods and services produced. What country's number three? Somebody said Mexico. Somebody said India. Kiki said, I don't know. Jason said Japan. Close, Jason. The correct answer, third largest GDP as of 2023 last year was, in fact, Germany. Hey, thanks for that, Mexico. Yeah, I'm losing juice right now. I'm trying to get juice back. I'm working to get it back. Bear with me, guys. I got horrible connection for some reason sometimes, so bear with me. Sometimes my video goes out, but my voice keeps going. So this thing may turn into a podcast. Who knows, right? But a podcast is cool, right? We can do a podcast, right? I got the right voice for a podcast. I got the radio voice for a podcast. So we'll see what happens. But hopefully we can hang in there. Germany has the third highest GDP, and Japan is number 4. Okay. So that's as of last year, right? Because GDP for this year, we don't know it yet. We're still in the beginning of the first quarter, or the end of the first quarter, beginning of second quarter, actually. But the numbers haven't come in for this year. USA, China, Germany, Japan, right? Give it a second. I think the video will come back up and just make connections getting better, getting better. So the GDP is just a measure of the monetary value of the final goods and services produced in a country in a given time, period. How do we measure? What given time? GDP is usually measured in quarters, right? Quarters meaning every 3 months. Connections getting stronger. Bear with me, guys. Connections getting stronger. Every 3 months is a quarter, and we measure a GDP in quarters. So what just happened today? We're in April. The first quarter is over. January, February, March. First quarter been over 3 weeks, right? More than 3 weeks. So January, February, March is first quarter. Oh, let me say this. When you hear the term, and you might hear this sometime, real GDP, that's just the value of the final goods and services produced in a country in a given time, adjusted for inflation. Real GDP is adjusted for inflation, right? So again, January, February, March, quarter 1. April, May, June, quarter 2. July, August, September, quarter 3. October, November, December, quarter 4. Today, we got quarter 1 GDP from January, February, March of this year. Okay, that's the numbers that we got, and we got the advanced numbers, right? But the changes in GDP every 3 months is the most popular way and one of the main indicators of a nation's overall economic health. Okay, that's kind of what it measures to us, or to humans, to us consumers, investors, or people, or citizens, right? GDP is up, economy's growing, everything's looking great. GDP is down, not so much. Not growing the way that we thought it would grow, right? The goal in America and any other country is to always have an increasing real GDP. And when I say increasing, I don't mean it has to go from 1.6% to 2% to 3% to 5%. I just mean it stays in the, is it in the black or in the green? It stays positive, right? Stays positive. Because that keeps the machine, in this instance called America, going. Growth, 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 growth. When there's no growth or slowed growth, that's when panic begins to sit in, or makes it in, right? Right. But that's what real GDP growth over a quarter to quarter basis, year to year basis, where everyone's working, everyone's grinding, and people are working and the money is flowing, that keeps the machine running, right? Now, how often is GDP numbers released? There's 3 versions of every quarter's GDP that comes out and becomes public and hits your Channel 5, your Channel 9, your Fox News, your CNN, your Bloomberg. There's 3 versions of every quarter's GDP that's released to the public. Okay, 3 versions, right? Each version's released each month. So today we got the advanced version of quarter 1. Now, in May, at the end of May, I think May 20th, May 30th, we're going to get the second release of quarter 1. And then we'll get, in June, we'll get the final release of quarter 1 GDP. So we get 3 iterations of GDP for every single GDP reading, quarterly reading, right? So today we got advanced and so forth. Right. And then here's the kicker. Each one of these subsequent GDP reports every single month, they become a little more accurate because more and more data comes in that they can actually decipher from. Right. So each one of these is more accurate. This first one may not be this. The GDP may end up at 2.1 by the time the third reading comes in. GDP the advanced numbers today could change, right? They get progressively more accurate because more and more data comes in. By the time May 30th comes around, we're going to have more data to decipher and figure out if this first reading, advanced reading, was accurate or not accurate. Right? That's kind of how this thing works, and you'll see it on TV. They never explain it to you quite like that, right? But right now, today's first reading, advanced reading for quarter one GDP 2024 showed a 1.6 growth, 1.6% growth. Go up, go down, right? Here's what they were expecting, and here's the problem. They were expecting 2.4% growth. We got 1.6% growth. Big difference. Huge difference. So the key for us as investors, consumers, is that we have to know that lower GDP happens, not a big deal. But how does this reading affect the stock market, our investments? The other thing we got to realize is that based on what we're seeing with inflation, and by the way, PCE inflation, I think that comes out tomorrow, right? High interest rates, though, are here to stay. That's my prediction. We got to know this as investors. We got to know this, right? Let me share my screen. If you're not on here, not on YouTube, guys, man, I wish you were over on YouTube. I want to share my screen real quick. Just go over something, because call me a nerd, right, guys? Call me a nerd, right? I'm a nerd. I'll take that. Not a problem. I'll take that nerd status. Not a big deal. Let me share the screen with you guys real quick. Give me a second here. Boom. There it is right there. Gross domestic product. You should be seeing that right now. Let me make myself real tiny in the corner. I don't have to be there. So everything I just talked about, what is the Bureau of Economic something is the BEA, right? Real gross domestic product increased at an annual rate of 1.6% for the first quarter. It's basically telling you everything. This is a public website from a government agency explaining what I just explained. Real GDP percent change from preceding quarter. Here we are right here. That's us. That's the first quarter reading right here. So let me get out of that, because that wasn't the website I think I wanted to share. Give me a second. I'm learning all this stuff, man. I'm brand new to this stuff. Let's see here. I'm getting there. So let me look back in the chat. Let's see here. That's where I want to go right there. All right. I'll look in the chat in a second. This is the one that I wanted to pull up right here. GDP growth slowed to 1.6% the first quarter, well below expectations. I'm going to do a refresh on that. Well below expectations. So I'll just kind of look at some of this stuff in the article. I want to share this with you guys. So there we go. U.S. economic growth was much, much weaker than expected to start the year. Prices rose at a faster pace. When prices raise at a faster pace, that's inflation, right? GDP, a broad measure of goods and services produced, increased at 1.6 annualized pace when adjusted for seasonality and inflation, according to the Bureau of Economic Analysis. Economists surveyed by Dow Jones have been looking for an increase of 2.4%, following a 3.4% gain in the fourth quarter in 2023 and 4.9% the previous year. So the last two quarters of last year, 4.9% increase in GDP, 3.4% increase in GDP. Now this first quarter, first reading, 1.6, way down, right? Consumer spending has increased 2.5% in the period, down from 3.3% gain in fourth quarter and below the 3% Wall Street estimate. So that's kind of, and I can go through some other things on here. For example, the PCE, this right here, the Personal Consumption Expenditures Price Index, which is what the Fed uses to try to get down to 2%. They say it's a key inflation variable, rose at 3.4% annualized pace for the quarter. Now, the real reading, I think, is going to come out tomorrow for the PCE. So we'll dig into that maybe next week. But point being is inflation is sticky. And I'll dig into that just a little bit, guys. Let me unshare my screen. How do you do that? Remove. Got it. Good. Man, I'm getting better at this, guys. Thanks for hanging in there with me. Let me go back to the chat like I said I would. Let's see. Third is Taiwan. Boom, boom. Just my boom, boom, boom. Oil got gas. Japan. No questions in the chat. I don't think so. I'm a nerd too. Smart Money Carter said it's all good. Tampa's in the house. Jin, good to have you here. Yeah, I got to work out those pronunciation issues. You're right. Larry brought up a really good point. Stock market was down, and we'll talk about that here in just a brief. Stock market took a tumble, right? Let me just go over this one real quick, guys, because again, I'm a nerd, right? Let's see here. Let's see here. Another article. I'm big. I like to read articles, right? Let's see here. All right, so go there. Check out another one. Reuters. In Reuters, right? The U.S. economy grew at its slowest pace in nearly 2 years in the first quarter because of the advanced readings we just went over. Surge in imports and a small buildup of unsold goods at businesses. Signs of solid demand that together with an acceleration in inflation, that's why the Fed won't be cutting rates anytime soon. The acceleration in inflation reinforced expectations the Federal Reserve would not cut interest rates before September. Reuters, they agree with me. I don't think we'll see a rate cut. We may not even see it in September. Okay? The cooler than expected growth rate reported by the Commerce Department in its snapshot of the first quarter's GDP on Thursday reflected a downshift in government spending, exaggerated the moderation in economic activity, domestic demand. A better growth measure was strong as consumer spending moderated slightly, while business investment picked up and the housing recovery gained steam. Just wanted to share that with you guys real quick as well. This is the issue. This is the big issue. We're getting to the big issue, guys. The big issue. The U.S. stock market is down. Today, finished down. I think it finished down, right? The stock market is anticipating the Fed won't be cutting rates also, right? The Fed is going to meet again in less than a week. I think the end of April. They'll meet again in June and maybe again in July. But I think it's going to be a while before the Fed cuts rates. Remember this, guys, about rates, and you got to know this as an investor. Cutting the Fed funds rate is inflationary. What did we just read in the couple of things we just looked at? Inflation is sticky. PCE inflation that the Fed wants to get down to 2%, which I think they're going to adjust that number at some point because it may be a year or two before the inflation gets down to that 2% level. Might be another year. But it's sticking at 3.4, 3.7%, the PCE is, right? It's staying where it's at, going up slightly, staying where it's at, going up slightly. So if the Fed decides to cut rates in a week when they have their meeting, per se, they won't. But if they do, what does that do when the Fed cuts rates? When the Fed cuts rates, it does what? It causes everybody to go out and spend money. The rates got cut. Interest rates are lower. I can go borrow money cheaper. I go borrow money cheaper. Now everybody starts spending. What happens when everybody starts spending? Demand goes up. What happens when demand goes up? Prices go up. So as soon as the Fed says they're going to cut rates, it means that people will start spending money. The Fed doesn't want people spending money because inflation has been sticky. They don't want to cut rates too soon and keep inflation going up. So it's a balancing act that they're playing, right? The Fed knows, and listen, we're in America, we're almost like puppets, right? This is why I say if you ever want to be wealthy and get rich with your money, you got to do what other people don't do. You got to be a person that doesn't follow the crowd when it comes to money. Everybody goes left, you got to go right. Because the Fed knows we're like puppets. We cut rates, everybody's going to go borrow, everybody's going to go ahead and start spending. It's going to cause inflation to go up because demand will go up and businesses will raise prices, right? This is why we have to think differently as investors that are aware and understand what's going on, consumers that are aware, right? Again, I don't think the Fed is going to be seriously considering cutting the Fed funds rate until probably September or later down the road. What does that mean? It means high interest rates are here to stay. Yes, the GDP fell. The output, the final goods and services output that America is putting out is lower, right? But inflation is staying sticky. And I think it'll be a while before they cut rates. That's my personal opinion. The stock market reacted negatively at first, rebounded a little bit today. But hey, what's going on with stocks? I mean, there's some big boys out there. The mega, what is it? The mega, I said mega, the Mag 7, right? The Nvidias, the Teslas. There's some stocks that are really, guys, on sale right now. If you're a savvy investor and you invest in single stocks, be looking at that, right? Could be buying time if you have some stocks or some ETFs that you're interested in or something like that. Things are kind of shifting down just for a brief, right? But the Fed won't be lowering rates anytime soon, guys. Typically, the stock market, as investors, you should know this as well. Typically, when rates are cut, the stock market loves it when rates are cut. When rates are cut, the stock market usually reacts good. Why does the stock market react good when rates are cut? Well, because when rates are cut, it means more spending. And not just for me and you, right? You know, we want to go out now. We want to get that car loan, or we want to get that personal loan at a lower rate, right? Not just for me or you, but the stock market loves when rates are cut because that means cheaper money to borrow and more spending, not just for me and you, but for businesses. So if you're invested in 500 businesses, 500 stocks, right? When the rates are cut, now those businesses can get out there and grow. Not only will they grow from people start spending their money at the businesses, but also they grow because it's cheaper to borrow money. So now a business wants to add to its fixed assets or wants to add to its inventory, its equipment. They can go buy the equipment, purchase the equipment, get a loan on the equipment cheaper. So businesses grow when rates are cut, right? Two ways. Money's cheaper for the business to borrow, and people are going to start spending more money with the business. So the stock market usually reacts favorably when rates get cut, right? Fed funds rate fall, people spend, demand goes up, businesses take off and grow. Stock market loves it, right? So what should we do? That's the kicker, guys. That's what I always like to make sure I talk about when we have these conversations is what should we be doing now, right? As investors, as consumers, right? What should we be doing? Let me look at the chat. I haven't looked at the chat, guys. I've just been talking away, guys. Do we have a question in the chat? Anybody chat in the chat? Looks like our connection's a lot stronger now, so that's a good thing. Let's see here. Nope. All right. So the Fed is going to keep rates higher for longer due to sticky inflation, not moving towards the 2% target. Curtis, you took the notes. Excellent. Fantastic. Let's see here. Let's see. You like that YouTube placard in the background. Yeah, that's the silver play button. Everybody said I should display it right there. So I said, I'll display it when I do a live or something. Rich, I didn't want to display it. I said, okay, I'll do it. Let's see here. The Fed is okay. Don't follow the crowd when it comes to money. Absolutely. Please don't do that. Somebody said I just sold some single stocks and bought Pam, I just sold some single stocks. Pam, how you doing? Shout out to Pam in the house. Good to have you, Pam. Curtis said, when do you foresee the Fed cutting rates? Again, I don't see the Fed cutting rates until at least September. We'll see. Think about it like this, guys. We get our GDP, we get our advanced reading and our final readings of GDP. We get a few more months of PCE, CPI, and PCE core inflation. We get a few more months of that, and we start seeing some things different. Right now, PCE 3.4, 3.7 could be down at by the time June or July comes around, July, August. Inflation could be down to more around 2.8, 2.9, 2.6. If that's the case, I think the Fed will begin to look at cutting rates starting in September. Okay. That's kind of when I think I foreshadow them actually making some moves. Pam said, I just sold some single stocks and bought more shares of my S&P ETF because they were on sale today. Congratulations to you, Pam. Fantastic, right? Being a cognizant investor. Again, guys, for the foreseeable future, borrowing money will remain expensive. This is my warning, my shout out to my consumers out there. When I say expensive, let's put this in the big picture. Fed funds rate being at 5.5%, big picture of the last 80 years, 70 years, that's not super duper high. Feels high to us because what we went a decade or so with the Fed funds rate being around 1 or 2%, right? A decade or so of money being super duper duper cheap to borrow, right? Think about in terms of your mortgage rates from 2012 to 2021. Mortgage rates were what for a 30-year fix? 2.5%, 3%, 3.5, 4, right? What was the 15-year fixed mortgage? 2%, 2.25, 2.75, right? So for a long time, we had this record low interest rate. So now that the Fed funds rate has eked around, I think the Fed funds rate is still around 5.25 to 5.5%. Now we're saying, oh my gosh, this feels like high interest rates. In the big picture, if you go back to the 80s, right, this ain't that high, right? When the Fed funds rate was inching around, 9% or so, and you could get a home mortgage for 15%. Car notes were, listen, my first car I bought, I said cash. The first car I bought, brand new car, 1988, I had a 20-something% interest on that loan, right? Which was high, obviously, but it was it was high even for the times, no doubt. But still, interest rates traditionally have not been in the 1 and 2 and 3% for mortgages, for car loans, right? So we got spoiled over the course of the last, before 2021, the last 10, 9 or 10 years before that, we were spoiled with interest rates. So interest rates are not incredibly high. I would not. This is why people ask me all the time. I get this question, guys. Hey, would you recommend us waiting to buy a home until interest rates go down? My answer to that is always 100% no. Go out and buy your home, your primary residence, when you're ready to buy a primary residence. Don't wait on the interest rates to go down because, now, don't get me wrong, mortgage rates and the Fed funds rate are not inherently tied together, right? Mortgage rates are more tied towards your treasury notes, but there's sort of an indirect relationship, right? Indirect relationship. So I say, no, don't wait on mortgage rates to go down because we don't know when rates are going down. We don't have no clue. You buy when you're ready and you refinance when rates go down, right? If you stay in the house or plan to stay in the house for quite a while, right? So that's my thing. Borrowing money will be more expensive. It'll be a little bit tougher for people to buy a house because of the higher rates. Higher rates on everything means higher payments, right? Harder to finance. Those home repairs and credit card interests are going to remain high as well. All right. The Fed funds rate serves as the basis, guys, for banks' prime lending rates, right? So when that Fed funds rate remains high or remains higher than we're used to, like it is now, it chokes off the ability for consumers and businesses to get things like loans easy. right? It's a little more restrictive. Banking becomes a little more restrictive. Right? Sometimes you'll hear that term, right? It just means it takes more to go get that loan. Maybe your credit score can't be 600, got to be 650, right? Maybe you got to put a little more down, right? But you're going to have higher interest, higher payments, right? Money doesn't go as far when interest rates are high. Important for us and businesses. If you're an individual and you have a business, it's hitting you on two fronts, right? But sometimes we forget the effect of higher interest rates on those mom and pop shops. If you own a small business, you rely on borrowed money quite often to fund your business and to make ends meet and to keep the shop open. And we forget about these higher interest, and how they're, affecting those businesses. So rates remaining the same don't only affect individuals, right? As I said earlier. So what do we do? What do we do as investors? What do we do as regular, average, everyday Joes and Joettes, right? What do we do? Let's see here. I'm going to go to the chat. Somebody says, investing, buying more assets. Frank Ellis. Congratulations to you, Frank, for being a good, solid investor. Somebody says picked up some ET yesterday. What is ET, Larry? Maybe I'm having a brain freeze. Bought some ETFs today. One REIT. Congratulations to you, Tracy, for investing in ETFs. My favorite. ETFs and index funds. ETFs, my favorite. Man, can I explain something to you guys? I had a conversation with a buddy about a week ago about individual stocks. Individual stocks. He said, "Man, I got to get me some of that. This got to get me some of that." And I said, "Man, that dude is working hard." He said, "Man, I got to watch this. I want to see if this goes down." And he said, "Man, I hate doing all this. It's very stressful." And I said, "Okay, yeah, it's very stressful investing in individual stocks. Absolutely. You don't have to do all that." Especially, he's a new investor. I said, you don't really have to do all that, right? You can invest in ETFs and you get all that stock, all them stocks in a bucket, and you can just walk away with your bucket and chill. And when you want to move stocks in and out the bucket, you ain't even got to do that. You let the fund manager do that, right? Even though ETFs are typically sort of passively managed, they still have fund managers. I told him, I said, "Man, you're working too hard. You're getting too stressed," because he's all up in a frenzy, watching this stock and watching that stock. He got about 10 stocks, and he's watching them like a hawk. And I'm saying to myself, okay, have you looked at the earnings reports on those? I mean, what's going on? What did first quarter tell you about? He didn't know. All he knew about was simply, watching how the stocks perform every single day, seeing what happens, what happened, what didn't happen, reading the news stories. I'm saying, well, what about their financials? He didn't know, because he doesn't know how to read a profit loss statement. He didn't understand how to read a 10Q. But he's investing in individual stocks and doesn't know how to read a 10Q. Bad move. That's bad investing. You're going to lose your shirt. I like to keep it simple, like somebody said in the chat. ETFs, keep it simple. If I want to trade them, I want to sell them, I want to play with them, do this, have this strategy to move in and out, I can do all that with an ETF. ETF is just a bucket of stocks. Way more easier for the newer investor, the average investor. Really, to be honest with you, way more easy for 90% of us. Because I work a job like most people. I don't have time to have this screen checking those that right there, that screen over there checking that right there, and then I gotta see what's happening right there. I got a meeting to go to. I don't have time to see what's happening with the stock up and down. I'm not day trading over here, right? You ain't got to do that with ETFs or index funds. You don't have to do that, right? You can if you want to with ETFs, but you don't have to. Make investing simple. Stop making investing super duper hard, right? Let's see here. Okay, Larry, energy transfer. Gotcha. Okay, Eric, do you have an email? I have a question. Yes, you can go into the description box on YouTube and you can find my email. Absolutely. So Frank said, why do I like ETFs? I'm laying it down. ETFs are just easier, right? They take less intensity. out of the day. They take less research. They take less of my know-how. I don't have to know. See, if I invest in, give me a stock. If I invest in Nvidia, I need to know what's happening with Nvidia, right? We don't even have to use Nvidia, right? We can use anything else. If I invest in Ford, I got to know about Ford, right? And I know Ford is one of those value stocks. They're gonna be around, but I got to know what's going on with Ford. What's happening with Ford? What does their financials look like? What is the CEO saying about the direction of the company? Are they losing money? They gaining money, right? What is their profit loss statement saying? What is their balance sheet saying? Did they just pick up a whole bunch of assets? Are they losing money every single month? What's going on with Ford? I got to know this stuff. That means I have to research Ford, one stock. I don't have time to research all 25 companies. I got a life. Not that if you do research it, you don't have a life, but I have other things that I'd rather be doing. Let's put it like that, right? So I don't want to do all that investigation of Ford. Ford, AT&T, Kohl's, Natural Grocers. I don't, there's, that's 10, I can name 10, 15. If I have 50 stocks, which you should have more than 10 or 20 stocks, you ought to have a bunch of stocks. You got to invest all those to properly be investing in them, right? You cannot just invest in single stocks by reading a story on MSNBC. You'll lose your shirt. So if you want to do it right, you got to dig into the minutia of the company. And this just too time consuming. ETFs, I don't have to do that. I look at 3 or 4 or 5 measures on an ETF to see if I want to invest in it. Right? Past performance, sector, tracking errors. You know, how good does it track what it's supposed to be tracking? Right? What does it cost? The fees associated with it, right? PE ratio, whatever it may be. I'm looking at those 3 or 4 or 5 things to determine if I want to invest in that bucket of stocks. And then I ain't got to do all that individual research. Look, I really don't have to. I could if I wanted to, but I don't have to. So that's why I like ETFs over single stocks. For the average investor, 90% of us, that's a more easy way. Here's another example I gave to help you out, Frank, with that question. When you look at ETFs, okay, when you look at the top 10 holdings in the S&P 500 right now, the S&P 500 top 10 holdings, top 10 companies that garner probably 28, 29, almost 30% of the weight of the S&P 500, right? When those if you owned those stocks separately as opposed to the S&P 500, the top 10 companies today were not the top 10 companies 15 years ago. That means 9 companies fell out of the top 10 in the last 20 years. 9 companies fell out of the top 10 in the last 20 years. If you were investing in those single stocks and you said, I'm just going to buy the top 10 companies as individual stocks 20 years ago, how do you know when to get rid of them? When they start going down? How do you know when Eli Whitney, was it Eli Whitney? Eli Lilly? When they went down, how did you know to get rid of it before it tanked and went really down? If you were invested in individual stocks, you don't know when, because you ain't Warren Buffett. I like to play basketball. I'm no Michael Jordan, right? I gotta know what I'm good at, what I'm not good at. Got to know my risk tolerance level. My risk tolerance level is not good enough to be predicting when those top 10 companies were going to fall out of the S&P 500. So I didn't mess that up and lose a whole bunch of money. I said, let me just invest in ETFs or index funds. In this case, let me invest in index funds at the S&P 500, where now somebody else is going to kick them out of the bucket when they start going bad. I don't have to lose money because now Nvidia only takes up 5% of my entire S&P 500 deal. So if Nvidia goes shot straight down tomorrow, loses, is in court, done tomorrow, guess what? If I own the S&P 500 stocks in a bucket, that ain't going to put a dent in my holdings, in my investment. But if I owned Nvidia as a single stock, my money is gone. Less risk in an ETF, much less risk. For us average investors, it's a better way to go. It's not as glamorous. It may not be as fun. It may not be as what do you call it? Exhilarating, right? Adrenaline. It's not going to give us that adrenaline that we can. Can we always see a good stock? No, it's just going to be simple. It's going to allow you to do other things with your time as opposed to stock watch. That's why I like ETFs, Frank. Lots of reasons. I didn't mean to go too deep into that. Let's see. I don't invest in single stocks. I do ETFs, index funds, and dividend funds. Great. Frank, you're on the money. You're doing exactly what I would predict and what I would do, Frank. So what do we need to do, guys? What do we have to do as consumers, as investors, right? Let's have that conversation. Okay. First thing is this, guys. And some of the things I say are going to be what I always say because I always believe in being steady with your money. First thing is make sure you have some emergency cash, guys. Always have some emergency cash for two reasons. One, for emergencies, but that it ain't bad to have a stash of cash in case you see something that you want to invest in. And that could be a separate account, but always have some cash. Let's put it like that, right? Always. Because you might see some ETFs, you might see some single stocks if you're a single stock person that dip, and you may want to buy the dip. Take advantage of market stagnation, take advantage of market downturns, have some emergency money. I would separate those two, right? Money for investments and emergency money, separate the two. But keep some cash on hand, right? Number two, be sure that you're spreading your money around. If I talk to one more person who only owns 3 stocks, right, I'm going to be upset. Seriously, guys, risk is something to consider. And I'm going to tell you on this channel all the time, always consider risk. Even with ETFs, there's a risk with ETFs. There's a risk with index funds. There's a risk with everything, real estate, commercial real estate, everything, land that you want to invest in, crypto, Bitcoin, whatever, Forex. There's risk in all of it. Gold, silver, you name it. There's risk. Always consider the risk. Don't think that you got a sure thing with no risk. That doesn't happen in the investment world. Everything revolves around risk. So be sure that you're considering risk in everything that you're doing. Another thing you can do is keep I don't see labor shifting. Let me just kind of shift to labor just briefly. I don't see labor really shifting up. I'm not sure when the new numbers are going to come in terms of unemployment. Maybe they came in last week. I might have missed it, but I don't see that shifting very much. But again, you want to have that stock of cash laying around just in case, because you don't know what's going to happen in terms of emergency money. Hey, the unemployment rates hovered around 3.4% to 3.9% for the last, year? Super duper low unemployment. But as things begin to shake out, we don't know what that looks like coming up. So we'll have to see, right? But it's always better to be safe than sorry. But think about this too. I'm going to throw this at you guys real quick. I don't know if you guys are thinking about this. I'm going to throw it at you to think about. If you're thinking about investing in real estate, I want you to think about commercial real estate. If you have a couple of $100,000 to spare, I don't know who you are on the chat, but if that's you, maybe you got $100,000 to spare. I need you to be thinking about commercial real estate. There's currently the beginnings of a sale on commercial real estate. I should pull up an article for you to read. But due to loans being due, right? More than $1 trillion, a little less than $1 trillion in commercial real estate loans coming due. Commercial real estate loans are not 15 and 30-year loans, right? Commercial real estate loans are shorter term loans than that. And so what happens in the commercial real estate industry, people are working from home. There's a lot of empty commercial real estate, and a lot of those loans are becoming due. And a lot of those investors who own commercial real estate can't pay because their rates have gone up. And when their rates have gone up and they can't pay, and the building is empty, there's no rent. What happens? They have to foreclose. Hey, if you're interested in commercial real estate, I want to throw it out there. Google it. so you can understand what's happening in commercial real estate if you're interested. And commercial real estate doesn't have to be some big downtown building, right? It could be a small little strip mall. It could be a small building, freestanding building that's in a decent area, gets good traffic, right? It could be a lot of different things when it comes, and maybe you could buy it for $40,000, right? Maybe if you have the money to spare, maybe you can buy it for $90,000. And you know you can get a tenant in there because it's in a good area. You know the area. You know the things are coming to the area or being built around it. Has good schools. Has good area. Has safe. It's safe. I mean, you name it. You do your due diligence. But just think about it, put it in the back burner. If you have $90,000 laying around, which some people do, right? One thing we run into sometimes when we don't have money, we think everybody else don't have money. There's people with money who's investing. And if that's you on this chat, think about commercial real estate. It might be an opportunity for you to get in the real estate game or to expand your real estate holdings, right? So Joyce said many tech support employees in the USA, including myself, have been laid off this year, unfortunately. Interesting, because the top 10 companies in the S&P 500 and the Mag 7, which is a part of the top 10 companies, they're mostly tech companies. So why are these tech companies who have seen some of the largest gains, got to start asking yourself, why are these tech companies who've seen some of the largest gains in the last 2 years, year and a half in the stock market, why are they all of a sudden laying off people? Interesting. But you got to think, as an investor, whether the stock market reacts negatively, stock market reacts positively, if you're a long-term investor, all those things shouldn't have that huge of an effect on you and what your strategy for building wealth through investments will be. Your job is just to take advantage of issues. When everybody else is panicking, don't panic. Stick to the basics, right? Outsourcing employees from other countries, is what Joyce said. Thanks for sharing that, Joyce. Stick to the basics. High interest rates are going to be what they are. You can't change them. You got to adjust a little bit. This is all to you. High interest rates are going to be high for a while, higher than normal for a while. What should your strategy be? And it also means, because the Fed won't cut rates anytime soon, we may still see some low points in the stock market. We're going to see the stock market, I think, go here, go here, go here, go here, go here, go here over the next 6 months, 5 months. That's my opinion. I don't think we'll be in this trajectory that we were in the first couple of months of the year, where we said, man, record highs, record highs, record high. I think at some point, first of all, we know that the stock market, when it was hitting those record highs weeks ago, the stock market was slightly overpriced, right? Everything it wasn't a big bubble, obviously, but it was a tiny little bubble, right? Maybe a little pimple right there. And we have to realize that from an investing standpoint. So don't get too high, don't get too low, stay steady, the basics, right? Stay with your investment strategy, whatever it may be, right? Be consistent, as in dollar cost averaging. Keep going. You can dollar cost average, and I like to call it dollar cost average plus, right? You guys know what dollar cost average plus is, right? Dollar cost average plus is this. Dollar cost average. That means put a certain amount of your money into the stock market, ETFs, index funds, whatever. Put a certain amount in every month, every week. Don't change, right? But I like to call it dollar cost average plus, because when you see lows, feel free to add a little extra. Feel free to add a little extra to your regular dollar cost averaging, right? If you're putting $200 a month towards it, $200 a month, nonstop, whoa, you see the stock market go down, whoa, your ETF index funds are down, boom, throw a little extra in there. Dollar cost average plus, right? But never pull back from your dollar cost average, right? Never say, I'm putting 200 in, I'm putting 200 in, now I'm only going to put a 150. Don't do that. 200, oh, big dip in the market, oh, everybody's panicking, 250, 250, 250. That's all I'm saying, right? Dollar cost average plus, right? Another thing that you should be doing right now is making sure you're not getting in over your head. There's a lot. And I mean, if you read the stats, guys, it says point blank, the last 5 or 10 years, there's more people investing in the stock market than ever before. Guess what that means? There's more people yapping and yapping and yapping on social media about what you should be invested in, what you shouldn't be investing in. It becomes like all this noise coming at you: Bitcoin, 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 right? Shibu Inu, Shibu Inu. You name the stock, it's coming at you. Boom, 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 boom. Cut that noise off, right? Only invest in what you understand. If you don't understand Forex, don't invest in it. If you don't understand commodities, you don't understand REITs, don't invest in them, right? Invest in things that you understand. If you love individual stocks, make sure you understand the company that you're investing in too, right? Don't just look at Nvidia going up and not understand what is Nvidia what does Nvidia do? Who is Nvidia? What do they provide? Right? Not it could be more than just semiconductors, right? What else do they actually do? Right? Know what you're investing in, right? Don't just jump into REITs and you know nothing about the REIT, the real estate investment. You don't know anything about real estate, but you just heard that REITs was a good place to be. Don't be that investor. That's not smart investing. See, that's more like gambling, right? But real investing is not gambling because you're able to understand, learn, and know, and read, and research, and have all of your ducks in a row, all your I's dotted and T's crossed, right? So invest in what you want, what you understand. But here's the kicker: if you don't understand it and you want to invest in it, then go learn about it before you invest in it. I'm not saying you can't learn. If you don't know anything about AI, but you really think AI is going to take off, you need to go learn about AI. Learn about the companies and why it's this and why it's that and what's coming and what's not coming and what happened, what led to this and what led to that. When you begin to understand AI, go for it. Invest in it. But just know what it is before you invest in it, right? And then, of course, diversify your investments, guys. Again, spread it out, whatever you're investing in, and don't panic. That's the kicker. Don't panic. Panic's going to cause you to sell your investments low and buy them high, which is the exact opposite of building wealth. Okay? Very important. So that's my warning, guys. High interest rates are here to stay for a while, right? And for us, as regular seasoned investors, that's what we should be doing and staying focused on. I like to make sure that I don't just talk about something without giving you what we should do, what you should be doing right now. I want to give you that because that's helping you, not just telling you that high interest rates are going to be here, but telling you what we should be doing as investors, as consumers. Good evening to you, Lanita. Good to have you here. Somebody said greed, tech, and the automotive industry. They're more worried about their investors than the employees that are creating the profits for them. Maybe. Could be right there. Keep it dynamic. Do I have a recommendation on literature about learning more about investing? Literature, books, investing. I always point to my favorites over here. Be honest with you, if you want to learn about stock market investing, any basic stock market investing book will do. I don't have a specific example because I didn't really read books to learn about the stock market. So I don't really have a specific stock market book to give you. I don't have a specific, and maybe some of you do have a specific stock market book or investing book. Mine is going to be anything by John Bogle, right? The founder of Vanguard. One of my favorites. So I read a lot of that. That's one of the reasons I'm a big index fund guy, right? Because I read his stuff. But if you guys have a suggestion for L. Drum about a stock market book or an investing book that you like the best, drop it in the chat. Please drop it in the chat because I like to help. I like people helping people. So you guys may have some suggestions. Please drop it in the chat. Any questions, guys? Let me run back to the chat, see if you have a question for me. If not, but let's see. Are index funds like S&P 500 really worth it? If Diego said, let me read this question, Diego. Are index funds like the S&P 500 really worth it if I had 100K? When you ask that question, Diego, are you saying you got to expand on that a little bit? Yeah, it's worth it because I'm a long-term investor. I'm not an investor that wants to buy, sell to make a bunch of money. Therefore, I'm a little more conservative when it comes to investing, right? And that's neither good, it's not bad. It's just my style. That's why you got to know what you can tolerate, what your risk tolerance is, etc. Right? But I like to buy and hold when it comes to real estate. I'm not a real estate, I don't like to flip necessarily or wholesale real estate. I like to buy and hold for the long term. It's just my demeanor. I'm a more safer investor, right, than some people. And if you're not, that's cool too. But for me, yes, I believe that it's good to invest in the S&P 500, right? Even if you have $100,000. So I'm not sure if I answered it right, but I hope I did. Let's see here. Tony Robbins has a new good one about money and investing. Never been a big Tony Robbins guy, but I know Tony Robbins was a Jim Rohn guy. And I like Jim Rohn, right? The speaker, Jim Rohn. So Tony Robbins was actually taught by Jim Rohn. He used to work for Jim Rohn back in the day. I don't know if you guys know who Jim Rohn is, but he was a speaker who had he was with that Herbalife or whatever, something like that. So somebody said, Art of War question, advice would you give to elderly parents who can't afford lifestyle if one of them passes away? Well, start getting your ducks in a row. Even if you're elderly, say elderly, I guess that means 70, 80 years old. I would suggest that you get some help. Advice I would give to elderly parents who can't afford lifestyle. I would say the biggest advice is to go ahead and and dial back your lifestyle right now while they both are living. Dial it back. Listen, I tell people to dial back their lifestyle in your 50s. When you get 50, 51 years old, you need to start dialing back your lifestyle, let alone 70, 80, right? But you got to start dialing back your lifestyle so that you can make sure you can afford your lifestyle when you retire or when one person passes away. So my biggest advice is to, cut your lifestyle down, cut your expenses tremendously, and get prepared. For most of us, we're going to be there. If you're in your 30s, cut your lifestyle back a little bit, right? I'm more of a frugal person, so you got to cut that lifestyle back. Otherwise, you're going to be in for a rude awakening. Art of War. I hope that helps, but that's the main advice I would give them. Cut that lifestyle back a little bit. Yeah, Michael said Jim Rohn is great. Yeah, I appreciate that. Yeah, he's a guy that's motivational. I like to listen to sometime. So, and don't forget, guys, I think I'm going to jump back into the Mag 7. I think, am I right about earnings reports came out for 4 or 5 of those large companies? Meta, I'll have to Google that, but Meta and some of the others may have had their earnings reports come out here just this week or maybe tomorrow or so. So the other thing, I think we have PCE inflation readings coming out tomorrow as well. And that'll be huge. That'll be really, really big. The PCE, notice how the PCE inflation readings, they come out about a week or less before the Fed has their meeting. The Fed meets again, I think, the 30th or 31st of it. There's no 31st in April, right? The Fed meets the 30th or the 1st of May. And the PCE readings are coming out, I believe, tomorrow. And that's going to, obviously, we know at this point, 95% chance the stock market has already built in that the Fed is not going to be raising rates. We pretty much know that, right? So with that said, the meeting that's going on, I mean, the PCE inflation that's coming out tomorrow still is going to be an indicator for us to notice and see as consumers and investors as well, right? Alphabet was today. Somebody said that's Alphabet's Google. Let's see. Why do you say that after the first 100K, your money grows faster? Oh my goodness, Caden, great question. Well, it does because of compound interest, right? When you have $30,000 in your investments and the market is up and everything, you may grow to $40,000 in a year. But when you have $200,000 in your investment and the market is up, you can see 50, you can grow 40, 30, 40, $50,000. When you have $1 million in there, it can grow by $200,000 in a year. It can fluctuate like that depending on the year. So just because of compound interest, the laws of numbers work, and compound interest works exponentially when you get past $100,000 and $200,000, right? Somebody said here, hey, Eric, this has become one of my favorite types of, You're welcome, Johnny. I appreciate you being here. That's okay. You can rewind back to the beginning and watch this thing from the beginning because it's all about this channel is really all about trying to educate people that are regular people that maybe don't want to have don't can't really follow or don't really want to follow um, Jim Cramer, and all his antics and stuff, right? Maybe you don't want to follow that type of stuff and you just want some real basic down to earth explanations and talk about money and the economy and what's happening. So that's what we do on this channel. We also put out regular videos, right? Regular 10, 11, 12-minute videos where I may hit on something in terms of personal finances. I may hit on something like I just released a video this afternoon. What was that video called? It was called 8 Signs You're Building Wealth. Keep going. If you haven't checked that out, guys, go to my page on YouTube and check out the 8 signs that you're probably actually building some wealth and you probably don't even know it that you're building wealth, right? Because what a lot of people need is they need encouragement with their money because people make mistakes. People end up 30, 40, 50 years old, 60 years old, mad at themselves, angry, bitter because they wish they had done this and they made a mistake 30 years ago and they feel like they can't get over it. This channel is all about trying to encourage you to say that just because you made mistakes before doesn't mean that you will have to keep making mistakes. You can do better. And guess what? The video that's out today, 8 Signs You're Building Wealth, Keep Going, is a nod to the people who are doing the right things with money, right? And you just don't quite see it yet, but you know you're doing the right things. It feels like you're doing the right things, but man, it's taking so long. You don't have patience. You get a little depressed, down, and discouraged. It's to say, listen, keep going, right? Keep going. Don't get weary in well doing. When you know you're doing the right thing, just keep doing the right thing. It will pay off. It may not be in the time that you think it's going to take, right? It may not happen when you want it to happen, when you think it should happen, but it can happen. It's going to happen, but you just got to stay on your path, on your focused path. Don't get off, right? Don't do what a lot of people do nowadays. Man, I saw this YouTube channel about Forex. Man, I always want to learn about Forex. That seemed pretty interesting. Let me go start trading for that Forex. No, stay focused. Man, I'm doing this side hustle right now. And you know what, man, I'm doing this side hustle. But man, I saw this guy on YouTube talking about this side hustle. Let me go see if I can do. We all over the place. And take it from a guy who has thought like that for a long time. When you become a jack of all trades and every shiny object gets your attention, it's easy to get off. And 10, 15, 20 minutes later, you're still off. You wish you had stayed on that thing, but you got off that thing because you saw something else shiny over here. Don't be that person, right? So right now, if you're watching this channel, you're trying to work on your finances. You're trying to work on your personal finances. You're trying to learn and get some financial literacy that's going to take you to another level. Listen, I'm not a guru. I'm not a fast talking money guru, although I talk fast sometimes. I'm not a fast talking money guru. I don't need you to hang out with me on my jet. I wish I had a jet. No, I don't. I don't like jets too much, but I don't need you to do all that. I don't even need you to buy my course. I don't need you to do anything. You can go to my YouTube channel, in the description box, and you can get your free 24 Laws of Money. Cool. Or you can sign up for a one-on-one, and I have to charge you for a one-on-one, but that's time, and I got to charge for my time. But all I'm saying is you need to develop your own personal philosophy. Take all this information that I'm throwing at you about how to look at the economy, how to look at it from a consumer standpoint, from a business standpoint, how to look at it from an investor standpoint, and you need to go ahead and do what you got to do for your own personal finances. That's all I can give you, right? That's all I can give you. And that's what I do on this channel. Try to help you out. This channel is almost free. Is it free? Is YouTube free? For most people, I think YouTube is pretty free, right? Don't cost you nothing for financial literacy, right? Again, I have to offer one-on-one personal financial help. I do that for folks, and I got to get paid for that, right? But that's it, right? Let's see. Somebody says, I fell into the Forex trap. Don't do it. Yeah, it's easy to get you, right? And day trading, you can make some money at day trading, but be careful about that one too, right? Michael said, keep going, do what is hard today so that your life will be easy tomorrow. Absolutely. Appreciate you saying that in the chat. Man, it didn't notify me what happened. Clint Perry, rewind this thing to the beginning. That's okay. I know some people, I like to watch lives later, right? There's people I watch on YouTube and I watch their live, but I'll rewind it back and watch it at my own time frame, right? Where I missed the live. But so if you want to watch it, feel free and do me a favor, guys. I haven't even said it. Have I said it? Smash the like button for me below. You got to hit that like button as you come in here, guys. Pushes this video out to more and more people. And there's all of us are consumers. We need to know this information. Many of us are investors. We need to know this information, right? Let's see here. Somebody says, do I have a boat? No, I don't have a plane, a boat. I drive an old Toyota Camry. Let's see here. Appreciate you. Oh, hey, keep on. I appreciate that, Clint. Listen, I'm gonna let you guys go. I've been on here for a while. I appreciate you being here. I appreciate you chiming in. I appreciate your questions more than you know. And I really, really, really appreciate you guys supporting the channel. I appreciate your support. And when I put something on YouTube in the community tab on YouTube, I always try to put something positive on there because I believe in speaking life. I think on Saturday, because I put a poll out. I don't know if you guys saw this poll, but I put a poll out on the community tab yesterday or the day before. I said, what type of video would you like to see from me? One of the choices was a regular guy giving advice, money advice, life advice. Listen, do me a favor. Tune in on Saturday at 11 o'clock a.m. I think the live will just be a regular guy, me, giving regular advice on life, on money, on everything. We can just have a session where we just ask questions. Hey, what would you do? What would you not do? Because I've seen a lot of life, believe it or not, right? Done a lot of things, seen a lot of life. You know, I'm in my early 50s now, guys. So I've been around a long time. As I say on this channel often, I've been poor, I've been middle class, and now I've reached some level of wealth. So I've been in a lot of different levels, seen a lot of different things, know a lot of different types of people to deal with, not to deal with, what to watch out for, what to not watch out for, put kids through college, etc., all that stuff, right? Married a long time. So I've seen and done a lot of things, and I can help you in a lot of different ways more than just money. And it looked like that was the winner on the poll. I think I had 1,000 votes. I'm just gonna pull it up right here and see what I had because I'm curious. I haven't checked it in a few less than a day or so. What I did was I asked a poll question. The poll question was, what video would you most like to see from me? And 42% of over 1,000 people said regular guy's advice on life. So I think that might be the live that we do tomorrow. I'm sorry, Saturday at 11 o'clock a.m. Central Standard Time. Just regular advice, having conversation. We could talk about money. We could talk about you name it, right? We could talk about hair. We could talk about cars. We could talk about everything. Doesn't matter. We could talk about whatever you want to talk about on Saturday. So please come back and join me. Somebody said Team Toyota for the win. Absolutely. I bought probably 6 or 7 different Toyotas, Corollas, and Camrys. And I think my next purchase may be a Lexus. We'll see. That's in the Toyota family as well. Let's see here. You are great at giving us the information, advice, encouragement. Thank you so much, Lanita. I appreciate you, and I appreciate your support. So we got a bunch of Toyota folks. Good. Pamela, thanks so much for all you do. And I appreciate you being here, guys. Listen, as I always say, don't forget to check the free stuff in the description box below. And listen, I always say this because I mean it. It's very important to me. These are my values and my money philosophy. I always say this, guys, at the end of each video. The absolute best person who's going to take care of the elderly you, the absolute best person who's going to take care of the old you and pay the old you's rent, pay the old you stay at the nursing facility, the person who's going to take care and buy you food when you get 65 and 70 years old, the person who's going to pay for your lights to stay on and for your water to keep running when you get to be 70 and 75 years old, the best person to do all that is the young you, the you today, the 35, 45, 55-year-old you is the best person who's going to take care of that old you, right? You guys take care of yourself, take good care of other people. Until the next video, peace.